Welcome to our eSignal weekly Forex forecast. My name is Jay Norris. I teach trading at Trading University. As always, we need to remind you that trading involves risk of loss and is not suitable for all investors. I want to give you something to think about. Before we hit the charts, here's a great quote from the physicist Freeman Dyson on one of his colleagues, Richard Feynman. Dyson said about his good friend Feynman, he had a physical picture of the way things happen, and the picture gave him the solutions directly with a minimum of calculations. And that's exactly what we do here. That's exactly how we see the markets. Of course, the paradox of that is the catch-22 of all that is if you're not of a mindset to believe that it can be that simple, you are just not going to. So the funny thing is we could show you exactly what we do, but until you believe that that's the way it works, it can work for you. It's not going to help you. So something to chew on. Always fascinating, human behavior. And after all, it's human behavior behind the markets. It's the collective subconscious that moves markets, right? First market we're going to cover will be the Australian US dollar. Aussie US dollar continues the downside, as we said last week, and we've been saying for some time. Our downside is going to be just right around 80 even. And we think that with the strength in the U.S. dollar now, really across the board, the Aussie kind of fought that for some time. You had euro weakness, whereas you didn't in the Aussie. Aussie's playing catch-up now, though. So we think you'll see 85 even in here. And with the momentum down and just with the overall U.S. dollar strength, everything going on out there, that the next stop, intermediate term, I'd say, would be 80 even. Next market, the dollar Swiss. There's the dollar Swiss. Wow, look at that guy. If we thought this was exhaustive momentum, then what do you call that? Well, you have to take a look at the big picture, the long-term picture, and that's what we keep stressing here. When you look there, it doesn't look like that big of a deal now on the monthly chart, right? So we've got to just pan all the way out and say, hey, we think par is going to be where this guy wants to go, intermediate term. Looking at a shorter term daily chart, it does look like it needs to take a break. On the other hand, we would definitely favor any break there, an opportunity to buy the dip. And we always talk about that buying the dip, the importance of that intraday. Here, let me show you an hourly chart, and here's how we view things. So don't think, hey, markets go straight up. This is a chart that we would work off of. This is a chart we teach off of. See these green lines in here? That's the exact same ratio. Basically, you're going to take the low of a correction to the high of a move. Bam, same ratio. Same deal here. You take that low to the low of the correction to that high, and then boom, same ratio. And then here's the longer term one. Here's where you bottomed out Thursday, and you're going to take that same low to the high, and then boom, that same ratio. So that's what we mean when say, hey, believe the picture. No doubt about it, the chart, the picture of the market is absolutely a reflection of the underlying fundamentals of that market. It can be that simple. It gets a little bit complicated as a trader in that, do you want to trade through economic releases? We teach that initially understand how markets move, then once you understand the risk, then it's really up to you if you want to trade through the economic releases. I don't think there's anything wrong with that. If you're having a good year, your long-term positions are really kicking in for you, then you can take those risks, and that's all it is. It's just the degree of risk you want to take. But long before you get to that point, you need to understand how markets move. You do not want to be surprised by big market movements. If you are, it's time to give it up or go back to the drawing board, right? Next market we're going to cover will be the dollar index. Here's the dollar index. You've got to, again, pan out to see the big picture here, to see where this guy's going. And we talked about that this breakout, in the big scheme, it's a relatively smaller breakout. It just portends a move on the old high, the 2009 high, which is pretty close to 90 even. So we think that's probably where you're going to go. You got a lot of time on the calendar left. You sure do. You've got a full 3 months of trading pretty much. You take off the holidays, you're looking at 2.5 months of trading till year end. So still a lot of room on the upside. We think 88 certainly achievable. Boy, it's a lot closer than it was just a few weeks ago, right? So 88 even would be an intermediate upside target in the U.S. dollar. So you guys are long UUP, as I am. Just, hey, hang on to that position. And here's the dollar index on the daily. And I marked the breakout there kind of hoping we get a pullback to that breakout, kind of resistance becomes support. But there's really not much room for hope in trading. You just have to go along with where the market wants to take you. You have to recognize that when it has momentum like that, and just let your long-term positions ride. So important to do that. Here's the euro. And look at the euro. You had potential support there. Boom, it sliced right through it. Here, another guy where you have to take a look at the long term, the big picture here. So no doubt about it, the chart itself is the best reflection of the underlying fundamentals that you're going to see. No doubt about it. It's a reflection of what's going on fundamentally as far as demographics, as far as global politics, certainly as far as economics. And the picture that we have painted here tells us you're probably going to go to 110 and beyond. Well, I don't want to get ahead of myself. Obviously, you have to get through 120 to get to 115 to get to 110, right? So I guess the bottom line here, this is a monthly chart. We think you're going to probe, you're going to get below that 112. You're probably going to go stretch it to 110 here. It just fundamentally, it's awful hard when you look at the underlying problems of Europe, and you at the same time you compare it to the major money centers in the U.S. You look at the individual cities in Europe and compare them to the money centers in the U.S. and it's definitely a different picture. And make no bones about it, that currency trading is all about relativity. The U.S. can have its problems, but relative to Paris, Chicago can have a crime problem, but relative to the long-term outlook of Paris, what do you see? What looks better as far as demographics, as far as things that have happened in the past that are more likely to continue? And it really is a game of relativity. So, and that's why trading really is it's an art for sure. And you're going to do better at it if you tend to be optimistic. You tend to see the good things because it's all relative. So there's the euro. If you pan out, if you scroll back down to a daily chart, it looks like exhaustive momentum again. But to me, exhaustive momentum can always take it a bit further. So and just throw it out. Look at that. You have a 50% retracement at 122 of that long-term primary of actually the grand pattern. So to us, 122 would be realistically a short-term target. Here's the gold market. No surprise here, you're continuing to see lower prices. We talked about this last week, how we showed you silver, a leading indicator, had already made a lower low. Silver already took out that low. No surprise, gold's going to follow suit. Here's a commodity I want to show you. Fascinating chart right here. This is very bullish for the U.S. It's really bullish for the global economy too. The crude oil closed below. You made a new 18-month low in crude oil. It closed below 90 even. Crude oil makes an 18-month low, closes below 98 even. Let me go to a weekly chart. I'll show you why that's going to be significant. That's going to be significant because if you take this low right there and you draw your retracement to that high, you're going to see that Gann's 625 level here has been penetrated on a weekly basis. So that's something you look for. If you get a monthly close below there, well, you have a weekly close below that significant 5/8 level there, 625. That's going to be significant. We see continued lower prices for crude oil. And what's that going to mean? That's like a major tax cut for U.S. consumers who probably drive more than anybody. I filled up the tank at 318 last week, and what that means, it's money in my pocket at the end of every time, at the end of the month. It's money in my pocket because I'm spending less on gas than I was before. It has the potential to be a windfall for U.S. consumers. We're already getting lower oil prices. What if oil drops down to 85, down to 80? Okay, it means more money in our pocket. So you drop out to a weekly chart. Now you could see how much you could see how much downside crude oil potentially has. I mean, at 2012 it was down to $70 a barrel. You go back down there, it's going to mean more and more money in the U.S. consumer's pocket because we're the ones that drive so much relative to everyone else on the globe. So, all this is supporting that strong dollar that we're seeing. No doubt about it. We talked about this 2 weeks ago, how we felt that the dollar index was actually foreshadowing the move lower in commodities, and now you're seeing it. We saw the strong dollar. Now you're seeing the weaker commodities, and we think that's just going to follow. I mean, a weaker commodity market goes hand in hand with the strong dollar market. So we think that's justifying the move that we saw in the dollar. And as we always say, the picture on the chart is absolutely a reflection of the underlying fundamentals. Last market, dollar yen. We were calling for 108 for a long time. It got there. Now we're saying, hey, with the momentum, you have 110, and you're almost at 110 here. There you go. Oh, it did. It tagged 110, and then it turned around pretty hard. But then on bullish employment number in the U.S., you jump right back there. So there you go. You had our long-term upside target, 110 in the yen. Hey, thank you so much. My name is Jay Norris. I teach trading at Trading University. Thank you so much. We'll see you next time.